Welcome to our class in Unit 3, where we're going to look at sources of finance. Sources of finance. Having learned that we have firms and corporations, sole traders, we could perhaps want to know, as part of the financing decision of the financial manager, on the sources of finance. So we have what we call internal and external sources of finance. So internal is within. We have retained profits, sale of stock, fixed assets, or debt collection, or owner's investment. External sources will include bank loans, uh, issuance of shares, leasing, hire purchase, mortgage, trade credit, government grants. So these are external sources of finance. In Islamic finance, we've heard of Islamic finance. What is Islamic finance? And this question once came asking to explain in brief. Okay, what is Islamic finance? So Islamic finance is simply, it refers to a financial system based on the Islamic law, the Sharia law. So it prohibits what interest, which we call riba, and promotes risk sharing. So it embodies ethical investment and fairness. So the goals here are to encourage equity and justice in the financial transactions. It avoids speculation and unethical investments. So the concept here is riba is any guaranteed interest on loans or unjust increase in wealth. So they don't believe in that aspect. So the concept here is that there should be strict prohibit. It's prohibited in Islam where you charge interest on loans, exploitive gains that will come from debt. So the alternative that they would want to encourage is profit sharing models instead of fixed interest. So if a bank lends 1,000 and charges 10% interest, must be guaranteed. Whereas in Islamic law, uh, when a bank lends or individual lends 1,000 in a profit sharing contract. So you will actually have to trade and you share whatever profits will be there together, not that you are being charged interest on there. So the Islamic law has instruments that they use. So they use specific contracts and instruments instead of conventional loans. So there's this concept called Murabaha. It's the cost plus financing principle, where the bank buys a good and sells it to a customer using a cost plus profit principle. So here the key point is you have a pre-agreed arrangement. There's no interest there. It's just the profit that is there. Okay. Then there's what is called the ijara, which is lease financing, where the bank buys an asset and leases it to a client. So the key point here is that the client will pay rent, not interest. So the ownership may transfer at the end of the lease. There's also what is called mudaraba, which is a profit sharing concept. So here it is a partnership where an investor who's called Rabuma will provide capital, and the entrepreneur who's called Madarib will manage the business. So the profits are shared according to the pre-agreed ratios. So this is basically um, what is involved in Islamic finance. So why do we need to study these sources of finance as financial managers? Because almost half of these new ventures will fail because of poor financial management. Now, sources of finance, we have different ways in which business can obtain money. So these can be classified into two, internal and external. Internal is raised within the organization, external from outside the organization. So we can look at the five internal. We've talked about owners, investment, retained profits, and the sale of fixed assets and debt collection. These ones are self-explanatory. They come from internal, then external. You need to understand the advantages and disadvantages. So the owner's investment, which is equity, the advantages are that you don't have to be repaid. There's no interest here. Disadvantage that there's a limit to which you can what? You can invest. Retained earnings, this is a source of finance which comes from the profit you make after trading. The advantage that it doesn't have to be repaid, there's no interest. The disadvantage is that it's not available to new businesses. Then sale of stock, this money that comes from you selling something. It's a quick way of raising finance by selling off what? An asset that will reduce costs associated. Disadvantage that business will have reduced what? Price for that stock because you want to make money. Sale of fixed assets, all these are self-explanatory. So I'll not waste much time in explaining this in the interest of time. But you must know that an applied question may come, for instance, a school. If I were to ask, you are at the university, can you explain any three sources of internal and external financing at the University of Lusaka quickly, or at your university? Frida, Lolanji, Lamek, give me the internal. Malambo, Mubanga, and Mutali, give me the external sources of financing at your institution.
So internal, we have debt collection,
Mm-hmm.
uh, selling of stock.
Mm-hmm. I want you to be more applied. Mm-hmm. The most direct one is school fees, isn't it?
Oh yeah. Yes.
Yeah. The external could be what?
Could be bank loans,
Mm-hmm.
is overdrafts, etc.
Yes, overdrafts and those things. Okay, so what is scrutinization? Uh, and why is it important? What are the advantages of this scrutinization? How does it work? And what essence is it for? So scrutinization is simply the process, financial process where businesses will raise funds by selling assets or future income streams to investors rather than borrowing directly from the bank. So the idea here is instead of you getting a bank loan, the bank will help sell the company's financial assets like the commercial paper, the mortgages, or receivables to investors. So these assets are put together and converted into securities that can be sold. That is what we call um, securitization. Securitization. So here is how it works. Number one, the company owns assets like loans, receivables. Then number two, assets are put together. These small assets are bundled into so that investors can buy them. Number three, you have what is called a special purpose vehicle, which is created. It's a legal entity that holds these bundled assets. Number four, these securities are sold to investors. So investors earn returns from the income generated by the assets. And number five, the asset will now get upfront cash, so they can use this for other operations. So this is what we call securitization. Okay, so it has its own advantages and disadvantages. So if you've never read about these things, you may not know. Okay, what is a euro bond and what are the advantages and disadvantages? So basically, these are the sources of finance that I wanted you to read about them, and I'll send you the notes so that you have time to scrutinize that. Ends our unit 3.